All right, guys, let's start. Okay. So today we are doing the chapter number 24 of your operational risk book. Chapter number 24 is about your Basel III, and we are now talking about your finalizing your post crisis reforms, right? Only one module, very short topic. You just have to understand what exactly happened post crisis and how Basel III regulations were kind of finalized after the 2007-9 financial crisis. Okay. This module sits after your credit, market, and CVA reforms, which you studied in your previous topic, your operational risk 23rd chapter. And here you are focusing on your operational risk capital, which Basel 3 fundamentally redesigned, right? So I hope now by now you must be aware that you have the background that before the crisis, we had your advanced measurement approach models, which kind of failed. Internal models led to your capital variability and underestimation. Basel III removed your AMA advanced model approach completely. And this module explained what replaced AMA and how operational risk capital is now calculated. Okay. So if you look at the structure of this module, right, when we go ahead and think about that, how this particular thing is covered, right? Uh, what we need to understand here is that this module is subdivided into your 7 topics, right? The first topic is standardized approach. We'll look at the new single approach which came into being after the financial crisis, the ILDC, SC, and FC calculation, which is the mechanics of your business indicator, the internal loss multiplier ILM, where you talk about the role of bank specific loss history, then the capital requirement calculation, comparison with earlier approaches, loss data, general criteria, loss data, specific criteria, and you look at the flow, right? You understand the business size, you adjust for the loss history, and then you arrive at the capital, right? That is how things move here. Okay, so keep that in mind. All right. So the first topic, right? The first topic here we'll look and try to understand is the standardized approach, right? When you talk about the standardized approach, please keep in mind, right? This is very theoretical in nature, guys. Just try to understand, right? It's a combination of 3 key elements. When I talk about 3 key elements, what does it mean? Basel 3 defines your operational risk capital as a function of 3 components, right? What are these 3 components? One is the business indicator BI. BI is what? BI is basically a proxy for your operational risk exposure, and it is derived entirely from your financial statement items, right? Larger, more complex banks need higher business indicator, and that means they will have your higher operational risk capital. Important point to note here is that BI is not loss based, right? It is generally dependent on your complexity of the bank structure, right? It reflects your scale, it reflects your complexity of operation, not your past failures, right? BI does not talk about the past failures, right? Then we have the business indicator component. When I talk about the business indicator component is basically your regulatory coefficient, right, into your BI, right? Now, what do you mean by regulatory coefficient? These are the coefficients which are progressive, not flat, right? Larger banks face higher marginal charges, and this introduces your size sensitivity into your capital, right? So that you need to incorporate. And then we talk about the internal loss multiplier ILM. ILM adjusts capital based on your actual internal loss experience. Two banks with the same BIs, right, business indicators, can have different capital if loss histories kind of differ, right? And why do we need this? Because this preserves a limited role for internal data without full modeling, right? So that is what we understand. Then we have business indicator component BI calculation, right? Sorry, not business indicator component, BI business indicator calculation, right? And look at the business indicator calculation. You look at the formula which is given in the slide. BI is calculated as the recent 3-year average for each component, right? Okay. So what do you mean by your BI 3-year component for your each of them? Basically, we are talking about BI is equal to ILDC average, right? Plus your SC average plus your FC average. What is ILDC? ILDC is basically interest, lease, and dividend component. SC is your services component. FC is your financial component, right? Why do we need 3-year average? Why this kind of peculiarity exists that we need to have 3-year average? Because the logic here is that we want to smoothen it out, right? We want to have a smoothened structure. That's why we are using a 3-year average, right? It smooths the volatility, prevents capital manipulation through your one-off items, right? So that is what we need. Okay. Now, once we have understood this, now we'll try to understand more about your ILDC, SC, and FC, right? When you look at your ILDC, right? ILDC is basically your interest lease dividend component. Why do we need that? Because it captures your core balance sheet income, right? Why do we need to calculate your core balance sheet income? Because we are trying to reflect your traditional banking activity. And then we have the services component. Services component is basically something which is capturing your fee based and service activity, very very important for your universal banks. And then we have the financial component. Financial component is basically capturing your trading and banking book profit and loss, right? And that is also important for your market facing institution. Together, if we combine your ILDC, SC, and FC, we are able to cover all your major banking activities, right? So that we need to understand. Bank are divided into three buckets which are given based on their BI size. This is a calculation as per your book. If the BI range is between your euro 0 billion to 1 billion, the calculation is 0.12 into BI. If it is between 1 billion to 30 billion, it is 0.15 into BI. And if it is greater than 30 billion, it is 0.18. So 12%, 15%, 18%. If it is between 0 and $1 billion euro, right, it is 12%. Then 1 to 30, 15%. 30 billion above, 18%, right? So the example is also given. If you have to calculate 40 billion, 40 billion will come above 30 billion, right? So how will you go about it? Like you will divide, right? So first one, 0 to 1, you will put 12%. Then 1 to 30, right? Which is the 29, right? So 29, 15%, right? And then how much is left? 10 is left, right? 0.18, 40 minus 30, 6.27 euro, right? That is the calculation for your BI, business indicator. Okay. Then, okay, sorry. One more thing which I want to cover before we go ahead is that please remember the formula. ILDC is equal to minimum of your absolute, you know, interest income average minus interest expense average. And then we have 0.0225 into IEA, right? IEA is interest earning assets average, right? Plus DI average, which is dividend income, right? You have to remember this formula, guys. This is, has been calculated empirically. You have to take the minimum value between the absolute value of I average interest income minus interest expense average, and then you have to take compare it with the 0.0225 into IEA average. You'd have to take the minimum value out of that, plus you have to add the DI average. Similarly, for services component, you have to take max of your OOI average, OOE average, and the max of FI, average, and FE average, right? FI is what? FI is the fee income, FE is the fee expense, OOI is other operating income, OOE is other operating expense. Again, you have to remember this formula. There is no other way you can move ahead, guys. Very, very important. Similarly, for FC, absolute, right? See, ILDC was minimum, SC was maximum. FC is absolute. Absolute net profit and loss for the trading book average, absolute net profit and loss for the banking book average, where profit and loss, PNL is profit and loss, TB is the trading book, BB is the banking book, right? So that is the calculation. Again, we have to remember. These three formulas are very, very important. When you look at ILDC, please keep in mind it is interest income minus interest expense, capture your basically the net interest margin. The cap is given there 0.0225, basically 2.25% of your uh, interest earning assets, so that you are preventing your excessive volatility. Dividend income DI average is added separately. Why do we do that? Because this ensures interest based activity contributes to BI, but in a bounded way, right? Then we have the services component. Services component is max of OOI average, OE average. The key idea here is, and then you have the max of FI average and FE average, right? Basically, the key idea here is that Basel takes the larger, right? It's the max, right? It's not the minimum. ILDC was minimum, right? ILDC was minimum, right? SC is not minimum. SC is max, right? So ILD was minimum. SC is max, right? So when you take the SC, right, SC when we compare, see the idea of your SC is that Basel takes the larger of income or expense. This avoids your understating activity when margins are thin. So even if fee income is equal to fee expense, activity is still realized, right? That's what the main idea. And then when we go to the financial component, then we take the absolute value, where TB is the trading book, BB is the banking book. It is very, very important to understand because absolute values are used. Both gains and losses increases your BI. Why? Because volatile profit and loss itself signals operational complexity and risk. That is why we are using absolute value, right? So keep that in mind. And then we have the bucket for BIC calculation, which I told you banks are divided into three buckets based on your BI size. Each bucket has a kind of a higher marginal coefficient, progressive capital impact, 12%, 15%, 18%. This prevents your small banks being over penalized, large banks being under capitalized, right? So that's the example we did. BI is equal to 40 million euros. First 1 billion, 12%, next 29 billion, 15%, remaining 10 billion, 18%, right? This progressive structure is exactly how BIC, right? Business indicator component is calculated, right? Please remember that. Now let's move ahead. Moving on, this is the numerical, the business indicator component in the standardized approach calculation for a bank with BI of your 13 billion will be closest to what? Again, same logic. First 1 billion, you have 12%, right? So you will have 0.12 into your 1. Then 1 billion to 30 billion, 15%, right? 0.15 into 12, right? So this comes out 1.92, and this is your value, right? So B answer is correct. Very, very straightforward, right? If you remember the tables, right? And that's what the calculation is. So I'll not discuss too much, but if you remember the formula, you can get it. Okay, fine. Moving on, guys. Next one is understanding, right? Next, which are the following components within the BI calculation takes into account a bank's trading and banking book P&L results? We know that, right? It's the financial component, right? The formula we have taken, right? So again, logic is from the table and from the slide. We have to take financial component explicitly includes trading book profit and loss and banking book profit and loss, and uses your absolute value, right? So keep that in mind. Okay, so overall, what have we learned till now? Basel III replaces your model based operational risk capital with a very structured, very transparent, and scalable framework. BI measures your size, BI applies your regulatory conservatism, and BI keep in mind your internal loss multiplier, uh, reintroduces your risk sensitivity without reopening the door to your model abuse, right? So that is what we need to understand here, right? So it's a very good standardized method we need to understand. Fine. Next one is your understanding of your internal loss multiplier, which I just said, which this standardized approach does. The topic, right? This internal loss multiplier can only be understood, right? If you have a good understanding of the first two topics. So, Sophia, so far we have studied your BI, business indicator approach, and we have studied BIC, right? So we have studied business indicator. What is business indicator? Business indicator basically measures your size and business complexity. Then we have BIC. BIC basically does what? BIC applies your regulatory coefficients to your BI, right? So up to this point, what we have understood is that all banks with the same BI, business indicator, look identical from a capital perspective, right? Now what we do here is we try to introduce another framework, which is ILM, internal loss multiplier, and introduce ILM to answer one question, right? That question is that should two banks, please listen to me carefully, should two banks with the same size but very different loss histories hold the same capital, right? Because if a bank has a checkered history, right, if a bank has a bad history, right, obviously there are lapses in the operational risk, you need to hold more capital, right? So the purpose of introducing ILM is internal loss multiplier is that it factors your internal losses into the standardized approach, making it more risk sensitive, right? So key idea is Basel III removes your internal model, but does not completely ignore your internal loss multiplier. ILM is the only place where past losses affect your capital, right? So ILM is a controlled reintroduction of risk sensitivity without reopening your advanced measurement approach style modeling, right? So remember the formula: ILM is equal to uh, natural log E1 minus 1 plus loss component divided by BIC 0.8. You do not need to derive this formula in the exam. You need to understand how it behaves. There are some important structural points we need to remember. The ratio is loss component divided by BIC, right, which you should be very aware of. If the exponent, you know, zero point 0.8 is given, right, that also you should be aware. Exponent 0.8 dampens your extremes, and you take the natural log ln. Basically that ensures your smooth scaling. And when you have this kind of formula, right, this particular formula, this particular design prevents capital collapsing to zero, right? That is one thing. And capital exploding due to one-off events, that also, right? So zero point 0.8 is to dampen the extremes, and your log ensures your smooth scaling, right? And what do we do in the loss component? When we try to understand the loss component is basically 15 into your average annual operational risk loss over the last 10 years. Why do we need such structure? Because if you use your long history, right, you get better idea, right? Long history, 10 years, better idea. Uses average, not the worst year. Much better scaling, smoothing. Multiplied by 15 to make losses comparable to BIC scale, right? BIC was also 15. So loss component basically converts your historical losses into a capital equivalent measure. And if you look at the impact of your internal loss multiplier, which is very, very important to understand, guys, please focus. Basically, if you look at the impact part, right? So this impact part is very critical, guys, very, very critical. ILM is equal to 1 if you get, right? If you get ILM is equal to 1, uh, meaning that bank's loss experience is exactly in line with its size. If the capital is equal to BIC, you don't need any adjustment. This is the neutral benchmark case. If the loss component is greater than BIC, right? If loss component is greater than BIC, meaning losses are higher than expected for the bank size, capital is scaled up, and this penalizes your weak controls, poor operational risk management. And in case 3, when the loss component is less than BIC, right? ILM is less than 1, right? Meaning that the loss experience is better than expected. Bank is a safe bank, right? So capital is scaled down for such banks. This rewards your stronger control. This rewards your stable operations. And ideally, if you need the data for such thing, the data requirement is 10 years of quality data, right? The logic here is that 10 years you are fully internal loss multiplier allowed. 5 to 9 year is transitional allowance. Less than 5 years, right, not allowed, right? It is ILM not applied, right? So keep that in mind. Only BIC is used for less than 5 year. 5 to 9 years, it's a transitional allowance. If ILM is not applied, right, operational risk capital is your BIC only, right? Keep this in mind. If ILM is not applied, operational risk capital is BIC only. And why do we do it? Because this avoids your unreliable loss data driving your capital, right? So when we don't have the history for 10 years, we don't want to get to the unreliable data, right? So that's the objective. Now, once we have understood this, now we go to the standardized approach for the capital requirement. Now, when I talk about the standardized approach for capital requirement, see, the core idea, the core statement here is that standardized approach is used to determine the operational risk capital requirement. And this point, right, what are we doing is we are combining your business indicator, we are combining your business indicator component and internal loss multiplier wherever it is applicable, right? So we have the business indicator bucket 1, right, where business indicator bucket 1 banks, right, where operational risk capital is going to be BIC, right? Why? Because small banks, limited operational complexity, loss data is often sparse or volatile, so Basel does not apply ILM here, right? Then we have the business indicator bucket 2 and 3, right? Here, the operational risk capital is BIC into ILM. These banks are larger. These banks have meaningful loss histories, have stronger data infrastructure. So Basel allows your size-based capital adjusted by your loss experiences. And then you look at the consolidated entities, right? This is an important governance point. Calculations use fully consolidated BI. Uh, Intragroup income and expenses are netted. Why do we do that? Because the purpose here is to avoid double counting, reflect true group level activity, and then we have the sub consolidated and subsidiary level also. You use your entity specific BIs. Loss data must meet your qualitative standards, right? If they don't meet, uh, it fails the loss data standards. 100% of BIC is used in that case, right? Keep that in mind. And this is the penalty for your weak data governance, right? So that we need to understand. Please remember it, guys. This is very, very theoretical in nature. You have to remember this for your exam, right? Very important chapter, guys. Lot of theory, but that doesn't mean that this is not important for exam. Basel regulation, especially finalizing something post crisis reform, is very, very important. Then talk about the topic 5, which is the standardized approach versus earlier approaches, where we are trying to summarize what we have discussed till now. So we are trying to understand why Basel III made this change. See, before the standardized approach came, right? Before, some banks use advanced measurement approach AMA, and in advanced measurement approach, right, what was given was it was introduced in Basel II 2006, allowed your internal models. It was principle based, it was highly flexible, right? Banks could choose loss distribution approach, banks could use scenario analysis method, banks could use correlation assumption. Now, with so much of flexibility, the challenge with AMA, advanced measurement approach, was that there was no comparability across bank. You could not compare Goldman Sachs with JP Morgan, JP Morgan with HSBC, HSBC with Morgan Stanley, Morgan Stanley with your Wells Fargo, right? No comparability across banks. Capital varied widely for similar risk profiles, also like Morgan Stanley and Goldman Sachs. And models were kind of opaque, complex, and difficult to supervise. So this was unacceptable, especially after your crisis, when such a big, you know, jolt have happened to the whole financial system, right? This was unacceptable. Then we started with the standardized approach, right? In standardized approach, Basel III response was very simple. They wanted a single approach. They wanted a non-model base. The uses were financial statement data, internal loss multiplier by your ILM. The goal was comparability, goal was transparency, and goal was your consistency. The, the key difference here, what we need to understand is that AMA, advanced measurement approach, was quite flexible, quite model based. It was bank specific, whereas your standardized approach was structured, standardized approach was standardized, standardized approach was comparable, and flexibility here, please understand, is deliberately sacrificed by, because we wanted a system stability which was not present during the 2007-9 financial crisis. Okay, so flexibility is sacrificed to keep the system secure, right? Fine. With that understanding, now let's get to the question, right? So if we try to understand question number 3 here, which of the following statement best describe a difference between the standardized approach and the older operational risk capital approaches, right? See, if you look at the first statement, the advanced measurement approach was introduced as part of Basel III division. No, it was introduced in 2006, right? Basel II. The AMA was more flexible, that we know, than the standard approach. Yeah, that seems correct, right? We're looking for the correct statement. The standard approach accounts for internal loss experience that were not factored into the AMA. No, AMI did account, right? AMA had the accounting for your internal losses, so this is wrong. The standard approach uses the model-based methodology, while the AMA was more flexible and principle-based. AMA obviously was more flexible and principle based approach, but standardized approach is non-model based, right? Not model based, right? It's a non-model based. Okay, so answer here is B, right? Overall, if you want to kind of summarize what you have read till here, Basel III operational risk capital is no longer about modeling your sophistication. It is about your size, it is about your consistency, it is about your discipline, and just enough loss sensitivity to reward good behavior and penalizes poor control environment, right? That is what is the whole idea, right? Uh, Now, once we have the understanding of this, now we get into this is what we did. I explained you all the options, so I'm not spending more time here. You can read it here. Uh, More flexibility than the new standardized approach. AMA was introduced as part of Basel II framework. I told you, AMA did account, right? for your internal losses, and standard approach is non-model based, where the AMA did incorporate your bank's specific models, right? So remember that. Fine. Now we are getting into your identification, collection, and your treatment of operation loss data, the general criterias. So in the same way, right, what we have studied, your first five topics, this topic builds directly on the internal loss multiplier ILM discussion which we had. So that is one part. Remember that ILM is only as good as the quality of loss data, internal loss multiplier. So Basel III lays down your minimum governance and data standards before losses, data, or losses can even be used, right? So there are documented processes and procedures. Bank must have your formal written procedures for identifying your operational risk event, recording of losses, your updating loss data over time. And this removes your discretion and ensure consistency across business lines, auditability, and supervisory confidence, right? Ad hoc or your judgment based recording is not acceptable, right? Keep that in mind. Then we talk about, right, once we have this understanding, then we talk about your information maintenance, right? Information maintenance is event level detail we need to incorporate, right? For each operational risk event, bank must maintain gross loss amount, loss before recoveries, detailed dates, date of occurrence when an event happened, date of discovery when bank found it, date of accounting, right? When bank booked in your profit and loss, recoveries, insurance recoveries, other recoveries, driver of the loss event, root cause analysis, process failure, system failure, human error, etc. Right? This event level granularity is crucial for your loss allocation, your supervisory review, your internal risk management, and then we look at the loss data accuracy. Right? Now, in loss data accuracy, what is the logic here? Basically, Basel explicitly requires accuracy and consistency. Right? Key clarification here is that operation losses tied to your credit RWAs are excluded. Market risk related losses are included. Very, very important. Okay. And market risk losses are included. Why? Because credit losses are already capitalized elsewhere. Market risk losses, which are the control failures in trading, still reflect your operational weaknesses. This avoids your double counting. When you look at the loss allocation, what happens is that bank must document how your losses are mapped to your specific event types, right? Very, very important. And how historical losses are categorized into your Basel II level 1 supervisory category. Again, the small things come in exam, guys. Please try to remember. Why do we do all this, right? Why do we do this loss allocation, documentation, and categorization? Basically, the idea is that we want to ensure your uniform classification, we want to have comparability across banks, and we want to have a stable internal loss multiplier calculation. Okay. Once we have done that, we move to the observation period. Now, for the observation period, we have 10 years of internal loss data. That is the standard. Minimum 5 years allowed during transition. And if a bank, right, please remember, if a bank does not meet the ILM usage or does not meet the criteria, ILM usage may be restricted and capital default closer to your BIC, right? So that's what we take. Okay, we default it to BIC, right? And this aligns with what we have discussed earlier under ILM also, right? Then we talk about the comprehensiveness and thresholds. Comprehensiveness means that the loss data must capture all material exposures, cover all locations, cover all your systems, cover all your subsidiaries. Selective reporting is explicitly disallowed. I'm repeating again. Selective reporting is explicitly disallowed. There are threshold. Initial gross loss threshold is like 20,000 euros, right? Can increase to your 100,000 for your bucket 2 and 3 banks. And purpose is to avoid noise from your immaterial losses, still capture a meaningful risk events. Okay, so that is what we are doing. All right. Okay, now we move into your topic number 7, which is the identification, collection, and treatment of operational loss data specific criteria. If you haven't understood now till now, please understand that first one was the discussion about your general criteria. Right? This discussion, which we did just now, is about general criteria. Now we are moving into your specific criteria, right? Now we are moving into your specific criteria. Okay, so keep that in mind very, very clearly that we need to have an idea about the specific criteria. Okay, what do you mean by specific criteria? Basically, now we are moving from principles to your execution, right? So first we talk about your policy for inclusion, right? First, the idea is that let's understand policy for inclusion. When I talk about, there's a lot of theory here, right? So policy for inclusion, when I talk about, please understand each bank must define which event qualify as your operational losses, what is included in the standardized approach loss data set, and this policy must be consistent. This policy must be applied uniformly. This policy must be approved and documented. And if you look at the identification of loss amounts, which is the next point, banks must clearly identify your gross losses. Banks must clearly identify your insurance recoveries. Banks must clearly put your non-insurance recoveries. The important rule here is that for the standardized approach, loss data is net of your insurance recoveries, but insurance recovery must still be separately tracked, right? And that is included in your gross loss calculations. The following must be included because they represent direct financial impact. Your external expenses. External expenses means legal, advisory, vendor fees. Your settlements, your impairments, your write-downs, your direct profit and loss charges, your repair or replacement cost, your provisions of your or reserves which are booked to income, pending losses, if financial impact is definitive, your timing losses, spanning your accounting period. The whole idea here is, like, please understand the guiding principle here is that if your cost is a direct consequence, right? If the cost is a direct consequence of the operational risk event, it is included, right? Now the question comes is what is excluded, right? What is excluded? See, if you talk about explicitly excluding the cost of system upgrades or improvement after the event, your insurance premiums, your general maintenance contracts for PP&E, right? Those are explicitly excluded. These are your ongoing business expenses, risk mitigation investment, not losses caused by an operational failure, right? And then when you look at the date, right, the date for your uh, loss data set, please understand that only date of accounting is used. For legal losses, the latest allowable date is when the legal reserve day is booked. And this avoids your retroactive manipulation, your timing arbitrage, and the loss allocation over time. What do you mean by that? If losses arise from a common event are booked over multiple years, they must be allocated to the year in which the loss occurred. And this ensures your accurate loss history, correct ILM calibration. So that's what we try to understand. Okay, so that is what it is, right? And when we move to the next part, which profit and loss items should be included in the BI component calculation, right? Please keep in mind that the logic here is that BI, right, business indicator, exclude most expense item. Exception is that items directly tied to operational loss events. Those are the exceptions. If you look at the options, right, administrative expense, this is excluded, right? So we are talking about included, right? So this is excluded. Your insurance premiums are excluded. Your depreciation of equipment, depreciation related to capitalized equipment is excluded. Provisions reversal related to operational loss event, that is included, right? So provision reversals linked to your operation loss affect the operational risk profile and are therefore included, right? So that's what we need to keep in mind. Please understand, right? And I think that is what has been given in the answer also. Provision reversal would normally be excluded except when it relates to operation loss events, which I told you each of the other three choices represent a PL and item that should be excluded from the BI component calculation. Okay, fine. Moving on, next is your understanding of or your practice question 5. Basically, if you look at practice question 5, in deriving the standardized approach loss data set for an individual bank, each of the following item will most likely be included in the gross loss calculation except, right? So what we are trying to find is which item is not included in your gross loss calculation, right? Now we have four options, right? Option A, legal fees tied to a risk event, right? Legal fees tied to a risk event are included, right? Are included. So we are looking for not included except, right? Included except, right? We excluded, right? So these are included. Settlements, a 2 million settlement tied to a recent operational risk event, that is also included, right? Your $1.4 million reserve booked to the income statement to cover a potential operational loss. Any reserve which is booked to income for a potential loss is included, right? Maintenance contracts for PP&E, right? Those are excluded, right? So again, here D is option. Please remember that PP&E maintenance costs are explicitly excluded under the specific criteria. Guys, you can't answer this question unless you have mugged up, unless you remember what is given in the chapter, right? So this is very theory heavy chapter, you have to remember it, right? So overall, what we understand, if you look at the options here, I think that is what we get. The costs associated with maintenance contracts for PP&D are outlined in the specific criteria for collecting operational loss data as excluded for the purpose of calculating the gross loss for the SMA loss data set. Okay. Overall, please understand that Basel III is not just about formulas, it is about your discipline in your loss data. If data is weak, data is inconsistent, data is poorly governed, the framework deliberately removes the benefit of risk sensitivity, right? So keep that in mind very, very clearly. Okay. So with that, this chapter is completed, guys. But again, I think you would have got the idea that this chapter is very, very, very theory heavy, right? And this chapter you have to remember a lot, right? You have to remember many points, right? You have to understand how each point is joined to another point. There are certain formulas which have to be carefully you know careful understanding is required, right? So what we'll do is that we'll do a quick recap, right? Even though chapter is smaller, I'll do a quick recap. If you look at this chapter, right, we are trying to understand the Basel III finalizing of post-crisis reform. There are 7 subtopics. You understand the standardized approach, ILDC, SC, and FC, internal loss multiplier, standardized approach for capital requirement, right, versus earlier approaches, collection, uh, treatment, identification, general criteria, and then the specific criteria. Okay. First part, you understand standardized approach, then you understand the formula and the calculation, very, very important. Learn, there are some numericals here, then understand the formula again, why do we take absolute values, and ILM is very important. Impact of ILM is very important. What kind of data requirements there is very important. Then bucket, standard approach capital requirement for bucket 1 banks, bucket 2 and 3 banks, very, very important. If it does not meet the qualitative standard, then what do we do? 100% of DIC is used, right? Standardized approach was earlier approach comparison. Then you get into your general criteria, the documentation, the information maintenance, the loss data accuracy, loss allocation, observation period, comprehensiveness, and thresholds you have to understand. And when we go to the specific criteria, then we are moving from principles to execution, right? The policy for inclusion, the identification of loss amounts included in the gross loss calculation, excluded, right? So included and excluded are very, very important, guys. Please, there are 2 questions given at the end for included and excluded, right? So you have to be very clear about clear idea about what is included and excluded. Remember that, and then we go to the practice question that we understand, and yeah, so that's it, guys. So that's it from my side for this chapter, guys. Go back, revise it, understand it. Uh, don't take it lightly. This chapter is one of very important chapters for your exam. Anything related with Basel is obviously important for your exam. So very, very important. Try to remember, try to solve it once you and try to understand the logic, right? Don't just try to mug up, because you should have an understanding, because they will check your conceptual understanding that why this, right? Why do we use ILM, right? Why do we take 10 years, right? Why do we take 15 years? Why do we try to average it? What is that 0.8, which is the exponent, right? Why do we use it? Because it's a smoothing, right? You don't want a blow up of the capital, right? Why do we do ln, right? It's averaging, right? So you need to understand the logics behind it. Once you understand the logic, I think that will be a great understanding, and that will be a very, very comprehensive knowledge for you, for not only for this exam but also for your career and for interviews, because this is very, very popular subject. This is what the banks do, right? So very, very important topic. Go back, revise it, understand it. If you have any doubt, shoot your questions, I'll be happy to answer. But that's it from my side, guys. I hope you enjoyed this particular learning discussion, and I'll see you in the next lecture. Okay. All right, guys. Thank you.